Welcome to this lesson on stop-loss orders, one of the most important risk management tools in investing. Stop-loss orders act as automatic sell triggers that help protect your capital from significant losses. Throughout this video, you'll learn how these orders work, when to use them, and how to set them effectively to safeguard your investments. A stop-loss order is an instruction that you give to your broker to automatically sell a security when its price drops to a specific level that you determine in advance. This predetermined price is called the stop price or trigger price. The main advantage is that you don't need to constantly monitor your investments. Once the stock hits your stop price, the order executes automatically. This removes emotional decision-making from the equation, helping you stick to your risk management plan even when market conditions become stressful. Let's understand how stop-loss orders work with a practical example. Imagine you purchase a stock at $100 per share. To protect yourself from excessive losses, you set a stop-loss order at $90. If the stock price drops and reaches $90, your stop-loss order is triggered automatically. The broker then sells your shares, limiting your loss to $10 per share, which is a 10% loss. Without a stop loss, the stock could potentially drop much further, resulting in significantly larger losses. There are two main types of stop-loss orders, each with distinct characteristics. The first is a stop market order. When the stop price is hit, this order sells your shares at the next available market price. It guarantees that your position will be sold, but the exact selling price may vary slightly. The second type is a stop limit order. This order will only sell your shares at your specified price or better. While this guarantees the price, there's a risk that the order may not execute if the market moves too quickly past your limit price. There are three common methods for determining where to place your stop loss. The percentage-based method involves setting the stop loss at a fixed percentage below your purchase price, such as 5%, 10%, or 15%, depending on your risk tolerance. The technical analysis method uses chart patterns, support levels, or moving averages to identify logical price points. Finally, the dollar amount method sets the stop loss based on the maximum dollar loss you're willing to accept on the trade, such as $500. Each method has its merits, and experienced traders often combine multiple approaches. A trailing stop loss is an advanced variation that offers dynamic protection. Unlike a regular stop loss that stays at a fixed price, a trailing stop loss automatically adjusts upward as the stock price increases. However, it never moves downward. This means that as your investment gains value, the trailing stop locks in those profits while still protecting against downturns. For example, if you set a 10% trailing stop on a stock that rises from $100 to $120, your stop loss automatically moves from $90 to $108. Trailing stops can be set as either a percentage or a specific dollar amount below the current market price. Stop-loss orders offer several important benefits. They limit potential losses automatically, remove emotional decision-making from your trading, work 24/7 without requiring constant monitoring, and enforce disciplined trading habits. However, there are also risks to consider. Stop losses can trigger during temporary price dips, causing you to sell before a recovery. In highly volatile markets, the execution price may differ from your stop price. Stop limit orders might not execute at all if the price moves too quickly. Additionally, gap downs, where a stock opens significantly lower than the previous close, can bypass your stop price entirely, resulting in a worse execution price than expected. To use stop-loss orders effectively, follow these best practices. Always set your stop-loss immediately after entering a position, not later when emotions might cloud your judgment. Consider the stock's volatility when choosing how far below the current price to place your stop-loss. More volatile stocks need wider stops to avoid being triggered by normal price fluctuations. Review and adjust your stop losses regularly as market conditions and price levels change. Finally, balance protection with giving your trades enough room to develop naturally. Setting stops too tight can result in premature exits, while setting them too loose defeats their protective purpose. Remember, stop losses are essential tools for disciplined risk management and should be part of every investor's strategy.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.